Welcome to the Barometer Readings monthly conference call. My name is Shannon, and I will be your operator for today's call. At this time, all participants are in a listen-only mode. Later, we will conduct a question-and-answer session. Please note that this conference is being recorded. I will now turn the call over to Ms. Sarah Potowski. You may begin.
Thank you, everyone, for joining us today for the Barometer Readings monthly conference call. I hope everyone had an enjoyable summer. My name is Sarah Potowski, Regional Vice President of Sales. Our last call focused on the market activity we witnessed over the spring and summer, with bond yields moving higher. During this period, we proactively protected capital for our investors and tactically positioned our income mandate to less interest rate-sensitive sectors. Year to date, all of our strategies have posted positive returns, which I will outline as of yesterday's close. The Barometer Income Advantage Fund is up approximately 6% year to date. The High Income Pool, 3%. The Barometer Equity Pool is up approximately 13% year to date. Our Tactical ETF Pool is up 7%. The Global Equity Pool is up just over 5% on the year. Our Long Short up 13%. And finally, our Global Tactical Balance Pool up 5.3% year to date. We are now seeing signs of stabilization in yield, which we feel can lead to a multiple expansion in select income names. The market appears to have priced in tapering, and we are positioned to take advantage of opportunities we see setting up in the market for the fall. Joining us on the call today is David Burrows, President and Chief Investment Strategist, along with Salman Malik, Associate Portfolio Manager. David will provide his thoughts on current market conditions, areas of leadership in the portfolios, and why we think there is an opportunity to put money to work this fall. At the end of the call, there will be an opportunity to address any questions you may have. With that, I will pass it over to Dave.
Great. Thanks, everybody, for taking the time today. What I thought I'd do is just quickly review some of the changes that have been taking place in the portfolio over the year, talk about what we've seen over the course of the summer, walk through how the portfolios are structured today and what things look like going forwards. Just as a quick review, in the meetings we've done over the last few weeks and the last conference call that we did, we spent some time talking about the transition we've had to go through, particularly in the income portfolios over the course of the year as a result of the rising long-term bond yield. And of course, that would be the expectation given that we do take a little bit more tactical mandate than some, that the portfolios may have gone through some significant change. Last November, highly focused in what I would call interest rate proxies, the REITs, corporate bonds, utilities, and of course, some pipes. And I think that was the right portfolio for the time. But as spreads started to change and the long bonds started to sell off, of course, we had to go through some reasonably significant moves. And so as breadth models started to show some deterioration in some sector work, clearly REITs came down as a significant piece of the portfolio. The corporates, especially investment grade, came down later through the spring. Telcos and utilities really came out of the portfolio. And all through that period, we saw money pretty steadily flowing toward financials and some consumer discretionary and some healthcare. So, our view has been, as I think most of you know, that we were seeing a cyclical backup in rates, that it did not necessarily, that a 1.5 to 2.8 or 2.9% 10-year didn't necessarily mean 2.9 to 5, but that, we could mitigate that rise in rates by owning things that benefited from some of the changes that were taking place in the economic data. So, clearly, the U.S. has led the world by way of slow, steady recovery, and U.S. equity markets have been outperforming. But when we look at the bond markets as they are today, I think that there's some interesting observations. So clearly, interest rates have been the biggest driver over the course of the year for our mandates, and I think for a lot of mandates. Long end of the bond market sold off about 16% year to date. If you look at just pure price move, which is reasonably significant, and against that, so we're obviously happy to have have positive numbers. We thought through the summer that we would start to see, after an initial sell-off in anything that was interest rate sensitive, that we would start to see some sorting take place. Because, of course, a bunch of the money that came out of the bond market wound up in cash in hands of people who ultimately need income. And so they were going to have to consider carefully what to do with that capital as to how to get a return in this environment, and maybe might filter its way back into things that were more relevant given a little different environment. So let's just talk about that a little bit. Long bond hit lows in July and rallied a snip only to sell off into lower lows in August and early September. And so that is pure interest rate sensitivity, summation of expectations for inflation and short-term rates. When you compare that to investment grade made lows in July, rallied somewhat and pulled back and retested lows in August, beginning of September, except they held. Of course, investment grade bonds, corporate bonds, somewhat more economically sensitive than the pure interest rate sensitive long U.S. government bond. If you take high yield, a little bit further out the curve, a little bit more economic sensitivity, lows in July, higher lows in August and September. So you can see the evidence of the market sorting process going on, and I think most of you know really the only bond exposure we've maintained through the course of the summer was our high yield bond exposure. We've been asked why we may have seen somewhat different performance in the high-income pool versus the high-income fund. I think one of the things you would say is that we maintained some bond exposure in the high-income pool, which would be difficult to replace, and felt that we would have an opportunity through the summer and fall to add high-yield bond exposure to the Income Advantage Fund, which, frankly, at this point has yet to emerge because issuance has been somewhat slow to come. We're not all that interested in stepping in and paying premiums in the market. But certainly the bond exposure could have some difference. But if you say what is it that's impacting asset markets overall, interest rates obviously are the most important thing. And, of course, we're all looking forward to, news on potential tapering over the next very short number of days. So interest rates have been the big driver. I think across any portfolios you've had to take those things into consideration. Anything interest rate sensitive has had an impact. When we get to equities, while the long-term models in general, breadth models stayed more or less positive through summer, some of our short-term, more tactical indicators started to flash yellow lights in August, and as you know, we saw some ups and downs and sideways chop in equity markets through August and coming into September, where, of course, you've always got the concerns around seasonal weakness. We also had some concerns around what might happen or take place in the Middle East due to the issues in Syria. Of course, lots of people concerned about next Fed chairman. And probably most importantly, what would happen in tapering. I always like to say that correction or consolidation takes place in one of two ways. It takes place in time, where markets work their way sideways, or they take place in price. And when it comes to equities, it's interesting that in the last 2 weeks, in the face of all of those things that you might get concerned about coming in September, all of our shorter-term models have slowly turned back higher as the market is climbing this wall of worry. So, why is it that equities, while they pulled back a little bit with the bond market, have really rallied back and worked back their way back to highs? Well, clearly the economic, we look at what is happening. Well, the breadth is improving in equities in a broad number of sectors. When we look underneath the surface at the sector levels, market is also sorting. Sectors that saw a little bit of weakness in the summer were more limited to things like telcos, utilities, more interest rate proxies. And the sectors that are a little more economically sensitive, consumer discretionary, industrials, energy, technology, outperformed and held up near highs. So, we know that the equity risk premium still relative to a long-term bond is very attractive. We know the economic data in general has been slowly getting better. We know that the U.S. has probably been the most stable of the recovering economies, which is probably why U.S. market has been about the strongest developed market in the world, aside from Japan, which has probably rallied for other reasons. So at this point, where we get to is that we have, across all of our mandates, pretty significant focus in equities. We have been focused in those sectors that were strong coming into summer and, frankly, have maintained their relative price performance through the summer. They all are sectors that had some interest rate sensitivity, but have turned nicely back higher as the tapering has been priced into the market. And here we are. We have industrials, we have healthcare, we have consumer discretionary, we have technology, and we have financials leading the market. And in varying degrees, the portfolios are made up of those sectors, from our income mandates at one end of the spectrum to our equity mandates at the other, in varying degrees. I would say that the expectation of seasonal weakness has certainly been built into this market. There certainly are some short-term issues that we may have to deal with as we go through September, but in general, we would say that the market is behaving remarkably well, given those shorter-term concerns and given the very significant backup in long-term interest rates. So if we framed it out, the bond market has backed up towards 3%. The sorting that's been taking place between investment grade and high yield would indicate that maybe we are getting there to the top end of the range and money is getting put to work. I think that's evidence of sort of short-term stabilization. The sorting that's been taking place in the equity markets, again, short-term sorting that's taking place. And here we are in the middle of September at a time when, over the last couple of years, we've seen lots of sloppiness and we have very resilient markets. So if we take the portfolios and break them out, as we've gone through the year in the income portfolios, financials have become a much bigger part. And that, of course, has been made up of both Canadian financials, which have been a couple of banks, but primarily insurance companies that benefit from higher rates. And some U.S. banks, in which we talked about as being, potential situations where we'll see dividend increases. When we go a little bit further under the surface into some of the other sectors, yes, they've pulled back a little bit, but have rallied back on to make new highs. Energy in the USA and Canada acting a little bit better. In particular, some geographic regions, which we can talk about in a moment. Energy infrastructure appears to be stabilizing. Consumer discretionary going on to make new highs. And if we break out the weightings in the Income Advantage Fund, for instance, 33% is financials, 16% would be energy, and most of those are yield-producing names. Consumer discretionary makes up close to 10%, and that really is a play on a steady improvement in the U.S. consumer. 72% of the U.S. GDP, of course, coming from the consumer, very domestically focused. Pipes still make up about 7% of the portfolio. That's midstream energy. Technology has come up now to about 7%. Just as a side note, it has been the case seasonally that technology tends to be strong in the fourth quarter. Certainly it's behaving the right way, and we are seeing big share buybacks and dividend increases announced in a bunch of these big cash flow generators. Most recently, you heard the comments coming out of Microsoft. REITs are fairly small in the portfolio currently, partly because of their strong interest rate sensitivity, about 7%, although they, in the U.S., appear to be firming, and it may be that you'll see us add some weight there. Certainly the yields are very attractive now, where the risk premium over a Treasury bond is over 400 basis points on many of them, which we think compensates us very well. And really, relative to historical spreads, looks like the REIT market has built in almost a 4% long bond. And I think that we're a long way from that. Media is now about 3.6%. So I guess the comment that we would make is between healthcare and media and consumer discretionary, many of the dividend payers we own have lower payouts, have substantial upside in their ability to increase what they're paying. They are positively economically sensitive without being out the risk curve to significant cyclicals. Now, many of you are invested in our income mandates, which have been a great place to be over the last few years, and I think they continue to be. I think that you're going to see a lot of that money that came out of the bond market get put to work through the course of the fall, and it looks to us like equity dividend is going to be the focus. But ultimately, there's only so far that we can go with an income portfolio when part of the return we're looking for is cash flow. And so if you went out beyond the income mandates, I think that what you would see is an increased focus in things like technology, both large and mid-cap, industrials, U.S. industrial sector hitting new highs. And when you get down into individual names, just talking our strategy, find sectors of the market that are seeing net inflows and then try and find specific names with catalysts where there's something good getting better. I'd use the example of something like 3D Systems, which is 3D printing technology, both fits into industrial category and into technology. And 3D has just been very unique in some of the acquisitions they've made. They really have made acquisitions across the spectrum of 3D printing. And I don't think anybody yet knows where 3D printing is going, but ultimately it looks as though the opportunity for 3D is a 25 to 30% growth rate over the next 4 or 5 years, and a leadership position in a bunch of the different technologies. So good getting better, obvious opportunity for multiple expansion as we've seen the numbers accelerate. Energy also has been a big piece of the equity portfolios as well as the income portfolios, and we talk about targeting sectors or parts of the sector maybe a little better suited to the current environment. We talked through the course of the summer as to how well some of the companies in the Permian Basin in Texas have been performing relative to the rest of the group, and that has continued. Just as an aside, often what leads going into summer slowdown leads on the other side, and that's exactly what's happening. Energy was strong going in, and in particular, companies like Pioneer and Diamondback were leading going in and come out and certainly are making new highs. So just on Pioneer, to give you a little bit of color, Pioneer PXD trading in New York have big assets in an area called the Wolf Camp, which have particularly big potential zones. Now, the companies in the Permian have been having some success in fracking sand. And Scott Sheffield, who's the CEO of Pioneer, talked recently and said that it was not impossible that this Wolf Camp could reach as much as 1 billion barrels of recoverable oil, which would really only be second to the Ghawar field in Saudi Arabia. So very big opportunity there. And when we look at the numbers, they have very low decline rates. Their recycle ratio, or the number of dollars of reserves they get for each dollar going into the ground, is about 3 to 1, which gives them great returns. They're going to have production growth of 16 to 18% a year through 2014, and they have a very significant number of targets to continue to work on. So that's an example of down at security selection level and at the fundamental level, finding specific names that could get significant multiple expansion against the group. And if we can get a tailwind from the group and get a tailwind from some of these specific names, like 3D or like Pioneer or like Diamondback, I think we're in a pretty good spot. And then ultimately, consumer discretionary, a big piece of the equity portfolio. So if we break out the equity portfolios, which I really think should be considered right now, given that around the world we are seeing some steady improvement. Technology is our biggest weight at about 28%. Energy would come in behind in a targeted way geographically at 23%. Consumer discretionary is about 20%. Financial is about 12%. Obviously, yield somewhat less important in these portfolios, a little bit more economically sensitive, and we think are a very good complement. Long short is not dissimilar. We continue to focus on developed markets versus emerging markets. I think it's interesting, while the emerging markets in the last couple of weeks have grabbed back some of the underperformance from the year so far, there has not been the same progress in the improvements in credit default swaps, which means there still is some credit pressure in emerging markets that could have been impacted by the strong dollar and the change in interest rates. Just the last point I want to make, we talked a little bit about the global pool over time. The one thing that you'd notice is quite different in the global pool relative to the other pools is, of course, we do have a significant U.S. exposure. Our next biggest weight would be Europe at about 25%, and Asia at about 5%. But the biggest weight in the global portfolio is consumer discretionary, just because really the global consumer is the one that's seeing some improvement. So if we can see continued improvement in the global consumer, and we continue to see some improvement in industrial production and capital spending, these sectors, I think, could perform quite well through fourth quarter. So we've always said, look, if you can grind your way through a rise in long-term bond yields in an equity income portfolio like our high-income strategy, if you can get to a more benign environment and money is still looking for yield, and it certainly is, then you could get pretty strong lifts. Each of the last 2 years, as we've gone through summer, we've had a backup in rates. And the fourth quarter in each of the last 2, maybe 3 years, has been a real money-making quarter. So as it stands today, and certainly things can always change, our equity risk models are positive. They are improving. Developed markets around the world are seeing some steady improvement against some potential risks in September. Fixed income markets have gone through a big move, but we think have probably moved as far as we're going to see them in the near term. And those sectors that are better suited to a little bit better economy are leading the market. So we're quite optimistic about fourth quarter. We have been putting money to work over the last short while in the income portfolio. We're still looking for some high yield opportunities. But coming into fourth quarter with good, solid, positive numbers, we're very pleased with, and I think that we're positioned well for the next 3 months to finish up the year. So maybe I could stop it there, Sarah, and if there's any questions, certainly we're happy to answer. Sal Malik's here. I'm here. We'll see what you got.
Before we take any questions, I just wanted to thank you again for joining us. Further to our commitment to transparency, we recently sent out the Income in a Rising Rate Environment commentary, which discusses the recent rise in yields and how we tactically position the portfolio to protect clients, which Dave just spoke about. And in addition, we sent out our recent Global Perspective piece highlighting our views on global markets and select areas of leadership. If you have not received these pieces that were designed to use with your clients or would like us to resend them, please contact Nick Hamilton or myself. As Dave mentioned, we see opportunities setting up this fall, and our portfolios are well positioned to tactically take advantage of areas of strength. We look forward to having you join us on our next call on Tuesday, October 22nd at 4:15 Eastern Time. And with that, I'll hand it over to the operator for any questions.